Hi, welcome to the Quarter 2 2026 live market update from Morton Brown Family Wealth. I'm Dennis Morton.
Hi, and I'm Katie Brown.
There's Katie. Katie froze for a second. That's good. Off to a good start. So welcome everyone. This is our 26th time doing this type of a live market update event. And the reason why we do this and the reason why we've done it so consistently, it actually started in the depths of the pandemic. We wanted our clients and our community to understand how we think about the markets and investing, how that ties into a long-term disciplined financial planning approach. Our goal is to help you understand our thought process and also give you a look behind the scenes to see the work that we do for our clients. So as we're seeing people populating the engagement here today, a lot of familiar faces, some new faces. Welcome everyone. Thanks for being here. We want this to be interactive. So there is a chat, a moderated chat. We want you to ask questions along the way. If we drift off into jargon or if you want us to go deeper on a topic, shoot us a question in the chat. But just to get us started today, we just want to ask each of you what are some questions or topics that would be important for you to hear us talk about today? We have an agenda and we're going to walk through what's been a really extraordinary first half of the year. But if there are things you want to make sure we cover, I want you to shoot them in the chat right now. We'll take a look at them, make sure we can address them and hear what's on your mind. So Katie, you want to start us off?
Sure. So a little bit about today. We really want to focus on what an advisor should be doing when it comes to your investments. So actually some background on our industry here and what has changed perhaps, and maybe what has not changed. I can remember going back 20 years or so at the start of our careers when advisors were pitching themselves as stockbrokers who could beat the market, or they were selling these high-cost mutual funds that were run by managers who could beat the market. There was always that sort of special thing out there. And fast forward to today, and we still hear about advisors touting that special access, whether it's to IPOs or private equity, private credit, annuities. We still hear all the bells and whistles about all the annuities, or even life insurance products. And Dennis, how many of these pitches do we get daily in our inbox?
It's kind of a running joke that we pass on some of the funnier ones. It's some pretty ridiculous stuff. And you figure somebody is getting paid to sling this stuff. And it's almost like we as advisors, I think part of our job is to play good defense and say, these are ridiculous ideas, making sure that stuff doesn't creep into, our portfolios or eat up our time. There's only so many hours in the day to kind of vet through all those things. Yeah. I have a story, an anecdote. This is going back to the beginning of my career, like 20 years ago, 2006 timeframe. So I was working at a Wall Street brokerage at the time, just starting my career, and just kind of watching how products were pitched to us. And at the time, our firm had acquired the advisors of another business, but also had sold their asset management business, their mutual fund business, to a firm called Legg Mason. And Legg Mason at the time had a star mutual fund manager named Bill Miller. And Bill Miller's claim to fame was that one of his funds had beaten the S&P 500 for a record 15 consecutive years. Everybody wanted to invest with Bill Miller. So part of this deal was our firm got exclusive access to Bill Miller's fund for 3 years. So that was in 2006. Katie, I'll give you one guess as to when that streak broke, the year that Bill Miller stopped beating the index.
2006, perhaps?
2005 was the last year, the year before the deal went down. So that 3-year window, in fact, I went back and looked up an investment news article from 3 years later in 2009 when that exclusive deal ended. And at that time, Bill Miller's fund had lagged behind the S&P 500 in 2008 by 18%. It lost 55% in 2008 and lagged behind the S&P. So it was just... And we see this happen over and over again. Things get pitched to advisors, they get pitched to their clients, and then stuff just falls apart and no one's there to be held accountable. So the reason we share these stories is because when we talk in these live market updates, we're talking about markets, we're talking about stocks, we might even talk about products like mutual funds or ETFs and things like that. But the products have to be right-sized when we talk about it. And we're not leading with the product, it's an ingredient in what we do.
Yeah. These market updates, they give us an opportunity to share with you, the viewers, and with our clients and future clients, a lot of the work that we do behind the scenes, a lot of the things that we are talking about, not just popping up each quarter, but really what we're talking about daily and weekly within our firm and across our advisors. So we love to kind of peel back the onion a little bit and share some of the discussions that we're having internally and some of the things that we are, working through. So Dennis, why don't you kick us off?
Sure. Let's go into, there's our slides. So we always start off with what's going right and what's not going so right. Glass half full. Stocks were up around the world in the first quarter, hitting some all-time highs, really had a sharp rebound. If you guys remember, back in March, the market had really dropped about 9 or 10%. The US stock market had dropped 9 or 10%. Starting in April, it began a rally that kind of has resumed trend through the first half of the year. Bonds also had solid gains. Unemployment is historically low, and the economy is growing. So there is really, I think, if we talk about what's happening in the stock market, it's very interesting how it's underpinned by very strong earnings that have happened, so that there's a solid fundamental reason why stocks have been up so far this year. On the glass half empty side, the war in Iran is ongoing. That started at the end of tail end of February. The market kind of digested that through March. Inflation has been reaccelerating. If we're going to talk a little bit about what that means for interest rates, that response, and also how kind of the market been on its heels a little bit in trying to figure out where interest rates are going this year. Sentiment is near all-time lows. Katie's going to give us a deeper dive on that. And then markets continue to be volatile, but we're being rewarded for that volatility. I think if you look across, and we'll talk about even emerging markets, domestic stocks, large and small, volatility and patience with volatility has continued to be rewarded. So Katie, why don't you talk to us a little bit about sentiment?
Yeah. We are at a really interesting time here when it comes to consumer sentiment. As Dennis mentioned, we are near all-time lows right now with how people are feeling about the economy around us. This chart here is looking at over the past decade or so. The blue line is from University of Michigan, the consumer sentiment study that they do, their survey, and we can see this sentiment kind of bouncing around. Remember, 2017 to 2020, those were some pretty strong years there, and we had some pretty nice, strong consumer sentiment. The pandemic really kind of knocked everybody down, as you might expect. But even post-pandemic, so the blue line being the consumer sentiment, went back, the green line being what's happened in the markets. So post-pandemic, it's been a rough ride from a sentiment standpoint. But look at this green line. Pretty smooth up. We've had some checks here and there, even as early as this year, some checks on the market performance. But other than that, a pretty smooth ride up. We've continued to have very strong market returns, and yet consumer sentiment has trailed toward the lowest levels that the University of Michigan has measured. And it's interesting, as we kind of think about this, because oftentimes we'll see those moving a lot more in line with each other. They're never always in perfect lockstep, but we see them generally going more or less in the same direction. And that just really hasn't been the case as of the past year and a half or so is when we really started to have a divide here. And I think a lot of this disconnect may be coming from, on the market side, I think there's a lot of optimism for what AI could be doing for the markets going forward. Markets are always forward looking. So they're sort of looking at that, they're kind of looking through an optimistic lens. And as Dennis, as you mentioned, profits have been strong, revenues have been really strong for companies. And so the markets have continued to have strong performance overall, but the consumer, that may not be the daily experience that the consumer is having right now. As you mentioned, once again, inflation pressures are back. If an individual, you might be seeing your investments go up, but if that money coming in your bank account and going out of your bank account is stressed because prices are higher, is maybe stressed because lending is more expensive. We haven't seen those rate cuts that we're potentially going to have. We're going to talk a little bit about that too. And so there could be more stress on the daily activities that consumers are dealing with, which might be, once again, part of that disconnect between how they're
Yeah.
feeling and then what's happening in the markets. So maybe
Katie,
you can go ahead.
No, I was just thinking, like, if you look at this chart, I think one of the things that we know to be true is that patient long-term investing works, and it's hard to be patient sometimes. And when things happen fast, stuff can break. Like the market's not designed to have things happen. And you look at, there's two things in this chart that happened with great speed. One was the pandemic. You can see that really sharp drop in sentiment that happened in 2020. That makes sense. The other thing that happened really fast was the rise in interest rates. And that's where you see that sentiment do a double dip right there in 2021 into 2022. That was prices going up 7, 8, 9% in a year. And I think this sentiment, we're still adjusting to that. That's still something that we haven't, and it's not, we're not, let's say never. It doesn't feel like we're going back. We're just not going to see those prices again. And I think consumers are still processing that because they see it at the gas pump, they see it at the grocery store, and it just happens so fast, faster than we're accustomed to.
Yeah, you're exactly right. And that's part of the challenge too, is when you set expectations in a certain direction and then it flips quickly, those expectations change quickly. That you said that's hard to digest. That's hard to maintain that confidence. I think a perfect area that we can point out this year where we've seen some changes in expectations have been in interest rates. So maybe you could touch on that, Dennis.
Yeah, I love this next chart. A couple of charts here. These are two things. On the left, these are the range of expected changes in policy rates from everywhere from the US to Australia to Brazil to the UK. And what you can see is that, there's the December 25th, and then there's the current. So there's been a massive swing in some of these changes going from, cuts to hikes or expected changes in rates. The chart on the right is what's really interesting to me. Here's where you have, starting at the beginning of this year, expectations for rate cuts, Federal Reserve rate cuts, were hovering between 90 and 100%. That's pretty certain. People were expecting the rate cuts to happen. And then we get to the opening of the Iran war, and expectations for rate increases go from being 0 to 10% all the way up into the 78, actually it's next to nothing, all the way up to 78% where they stand right now. We talk a lot about, we don't come on here to do predictions. This is why. Because if you're 100% certain of something, you can get caught offsides. There we go, football term, soccer term. You can get caught, nobody understands offsides anyway. But you can get caught offsides and have the wrong trade in place. The key when you're navigating interest rates or the related bond market, where you're trying to time purchases, is not getting caught offsides and put in a place where you're committed to one particular outcome. Because as you can see in this chart, within a matter of weeks, it goes from 100% certainty, down to nothing. So it's just a really telling thing. We do have a new Fed chair. There's a lot of, there have been some questions about what Kevin Warsh's philosophy is going to be. It seems that he's kind of united the Fed a little bit about rates holding steady to higher in the near term if necessary, if inflation remains persistent. But again, we're not in the business to make predictions. It's one of the reasons why we invest in bonds the way we do. We'll talk about that here in a little bit. Katie, you want to move it over to bond returns so far this year?
Sure. So we're looking at a couple of different segments here on the bond returns. Over here on the left-hand side, different maturities, specifically focusing on US Treasuries. And we have them organized, actually both sides organized from top performers down to the bottom performers. The darker areas being the quarter to date returns and the lighter areas being the last 12 months return. So the 1 year return, ending through that second quarter of 2026 here. And we can see, bonds this year, I'm going to say bonds this year, bonds over the last 1 year on both sides. It's really been a matter of whatever that yield has been, that's pretty much what we're gathering from the bonds. So they are providing, a lot of that stability. And I think they've actually managed pretty well through a lot of those rate expectations over the years. We see a little more swing when it comes to, longer dated bonds and how they are reacting. Once again, on this side, focusing on the treasuries. On this side, we're looking at things, corporate bonds, municipal bonds, international bonds. And then we've seen, once again, some solid returns from bonds, but there hasn't been a whole lot of that price fluctuation that has occurred. And it's been an interesting market to watch as we've started to see some of the rates, I'm going to say, normalize a little bit over the past year. And so we're, picking up some decent yields from the intermediate corporates and intermediate municipal bonds have been very strong, even on a year-to-date basis and over the past year. But, same as we talk about with equities, don't underestimate some of those outlying positions, those diversifiers, and international bonds also providing some additional stability to the bottom line in the fixed income markets this year. Anything jump out to you, Dennis, specifically when it comes to the bond conversation?
Well, one, I think that and we're going to talk about this when we go out and, talk about buying the bond market. You can buy the aggregate bond market. It's going to include a lot of these things, like especially the ones on the left. If you're buying, a bond fund, maybe in a 401k plan or something like that, it's going to have short-term, intermediate-term, long-term bonds, just the whole thing. We want to be a little bit more selective in how we do that. And I'm going to show you why if we go over to the next chart. This is a little bit small, but I'll tell you what you're looking at here. This is the importance of dividends when it comes to your bond performance. We know bonds are not like stocks, but here's an important reason why they're not like stocks, is that the major factor in the performance of bonds is not the price going up or down like a stock, but it's the income that you receive from it. And presumably you should receive more income for a long-term bond for lending for a longer period of time than from a short-term bond. Think of the money that you would earn on a CD or a money market fund versus what you get on an intermediate-term bond. What the top chart shows you is 3 investable funds, which is important, not just indexes. These are funds that you can invest in. The Vanguard long-term investment grade bond fund, intermediate term, and short-term. Over the long term, you can see that this is over the last 20 plus years, 25 years. You can see kind of a 263% total return, interest and principal on the long term. Intermediate terms at 216 and shorter terms 130. If you take out the dividends, that's the chart on the bottom. So look at that volatility in long-term bonds. This is one of the reasons why we tend to not buy the aggregate index, because we don't like owning long-term bonds typically. Because what happens is if interest rates get wild, they act like stocks. And you can see that massive downdraft that happened when interest rates went up in 2021 and 2022. So we tend to stay more on the short and intermediate term side and then rely on the income that's thrown out. And this is an important time to talk about that because we're midway through the year. And you might, if you're looking at a bond fund, you might see it kind of waffling back and forth, hovering around flat for the year. But you've only collected 50% of the income that's going to be paid out this year. There's still another half a year. And we know that that's a good portion of the total return that we expect over time. So as Katie pointed out, looking at that 1 year trailing history is important, and the forward expected returns, how much is this fund going to pay me, can be a good predictor of performance.
Yeah. Dennis, I appreciate you mentioning that, like as far as how we approach it, because different investment advisors may have different approaches when it comes to fixed income. We've always leaned toward, we want our fixed income to perform as expected. We don't want to be surprised on the fixed income side. Like that's our stabilizing part of the portfolio. That's where, we have a certain level of certainty around how much income is going to be generated. And we want our stocks to be the ones that are going to be a little more volatile, not necessarily those bonds.
Yes.
So it is part of our philosophical approach when we put together our portfolios.
Very true.
Yeah.
So let's talk about stocks.
Mm-hmm.
Here.
Oh, wrong direction. Here we go. All right.
This is our first rodeo. We'll figure it out.
On the equity side, similar to the fixed income chart that we were looking at. We have a couple of charts here, one focused on the US returns on the left side here, the darker area being the quarterly returns, the lighter area being the annualized return, the 1 year return, I should say, also organized from top performers on down. And then on the right-hand side, looking at the international returns. So the emerging markets, the developed, large value, developed growth, and also small international small companies as well. And so starting on the US side, this has been an extraordinary year for US small caps. Both growth and value, we're seeing a little bit of outperformance on the value side versus the growth side of the small companies. And then over here on the international side, extraordinary year for emerging markets. These are the things that don't always get the headlines. US markets, I don't want to take anything away from the large cap markets because they have had a very strong year too. We're seeing the total stock market up about 22%, US large cap value up 27% over the past 1 year. This is the past 1 year on a year-to-date basis, value up almost 14% and growth up 16.7% on a year-to-date basis. So once again, very strong performance on the large cap side, but really we're seeing the small caps in my mind they're the story. And so, once again, just to put in context some of these diversifiers and why it's so important to have these other areas rather than just following some of the headlines, because the headlines don't always pick up these ancillary areas. On the emerging market side, again, 43.5% over the last 1 year of growth and 24% from this quarter. So very strong returns in emerging markets and also international small companies up, right in line with almost US large returns down or up about 20% on a 1 year basis and 10% on a quarterly basis. So it's been interesting to see some of the shifts in what's driving some of the different returns of the markets, and we can get into that a little bit more. But it has been, this to me, once again, just hammers home, make sure you're well diversified because we don't know when that leadership is going to change. And we've talked about that quite a bit. Is the leadership changing from large to small? Is it changing from US to international? And if you're not already there, you're going to miss out on these opportunities.
Yeah. Katie, what was my complaint allocation for this particular session? Do I get one? Can I use that right now? Complain about something?
Please feel free.
Okay, thanks. So how much oxygen was expended in the second quarter of this year on financial media talking about SpaceX, talking about possible Anthropic IPO, talking about all of the stuff? Now look at that US small value. I'm looking at a small value fund. We like to crack these open and see what's inside. There's 40+% returns over the trailing 12 months for a fund that has, less than 10% in technology. It's small banks, it's industrials, it's miners, it's, consumer cyclicals, materials. It's all the stuff that is not in the headlines. And it's going gangbusters. And that's not one company. That's hundreds of companies doing that. And it's just, it doesn't get the news, it doesn't get the headlines, but you gotta have a piece of it. Same thing with technology. If you want tech exposure, and this was an interesting, when we talked to our chief investment strategy team last week, we had our monthly meeting, and Eric Stein from East Bay was talking about the composition of emerging markets. We talk about buying the right fund, knowing what's in your fund. Some emerging markets funds don't characterize South Korea as a small cap or as an emerging market. They consider it a developed market. And if you didn't catch North Korea or South Korea last year, it doubled. The whole market was up 100% because of so much semiconductor business that makes up that country's economy. So knowing what's inside of here, if you have an emerging markets fund that doesn't consider South Korea to be an emerging market, then your performance is nowhere near that. So it's a very interesting time to understand what you own, make sure you have broad exposure, and know that it's not always the headlines that are going to be the best performers.
Good point. What does capture the headlines though, Dennis?
Oh, IPOs. Let's talk. Here we're going to talk about IPOs and also talk about why we don't talk about IPOs. As I said, we watched the SpaceX IPO not as wanting to participate in the IPO process. We'll talk about why, but just to see can the market digest this? It's a very large company coming into the market. There were a lot of mechanical issues that could have emerged. I think one of the signs in the second quarter of a healthy market is that SpaceX has been absorbed, is starting to make its way into indices, and is also showing the risk and reward based on the price volatility recently. So we wanted to talk about that a little bit. This chart, what this shows you is some of the technology IPOs from the last 20, 25 years. You'll see some names that are highlighted: Facebook, Twitter, Palantir, Robinhood. On the x-axis is the 12-month returns after IPO. On the y-axis is the max drawdown of that stock over time. The average 12-month return for the 30 companies that are plotted on here was 15%, although half of them, less than half of them, had 12-month returns that were positive. The median or middle return for these companies was negative 9% over 12 months. The kicker, though, is during that first 12 months, the average drawdown was 55%. So even for the ones that were positive, the average drawdown was negative 55% during the first 12 months. So you can see just all this volatility. Palantir was up 153% a year after the IPO, but it was down 53 at one point in the interim. Twitter finished the year negative 10, was down negative 58. And Robinhood, this is an interesting one, because Robinhood was the #1 performing stock in the S&P 500 in 2025. But from its IPO a few years ago, it finished the year negative 74%. At one point was down 90%. There is a ton of volatility embedded here. Eventually, if you're an index fund owner, eventually you're going to own these in one form or another inside of your index fund or inside of even an active fund. But it's important to understand or expect that this kind of volatility can happen.
Yeah. Even from the index standpoint, I know some of the rules have changed around a little bit, especially with the SpaceX IPO that came out this year, just because it was such a large company. And so some of the indices did change their rules to allow them into the index sooner. But most of the indexes, they have certain protocols in place to make sure there are quarters of profitability before they start to bring in some of these new names, these IPOs. And a lot of that is to let some of this stuff wash out. It is very, very tricky to time the purchase or to get in an IPO and feel really good about it for that first year. It doesn't always happen right away. There's a lot of volatility, and you really have to ask yourself, can you stomach that? Does it make sense? Does it not make sense?
Okay. So let's talk about that sector of the market that we said has been really kind of flying under the radar and is not qualifying for, it's not in the IPO space.
Yeah. So turning our attention back to U.S. small caps again, looking at Russell 2000 being representative of the small cap index here in the United States. This is looking at 6 months returns going back to 1980 and putting them in order between what were the 6-month periods of the best returns in small caps. And as we talked about this year, the first 6 months of this year being up 22.6% in small caps is really extraordinary. There have been very few periods, we can see them listed here, 83, 82, 2020, 91. We can see different periods where we've had very strong performance before, but this has been one of the top 6-month periods. And the strongest first half of the year performance for small caps in the last couple of decades. So as we talk about, it really has been extraordinary. And much of the drivers for that have been, the companies that are helping to support this AI infrastructure. So the microchips, the semiconductors, really driving a lot of the performance within the Russell 2000. It's interesting, it's not listed here on the chart, but if you looked at over the last 2 years, the Russell 2000 has actually outperformed the Russell 1000, being the large cap counterpart, the large caps, by 4% annualized over the last couple of years. So once again, that change in leadership, the change in the tide, we don't know exactly when it's going to happen, but we need to make sure that we're present to capture that, because there are periods of time when that happens and we have significant outperformance coming from maybe some pockets that aren't getting attention or aren't getting the headlines. So just wanted to put in context, once again, how credible, how powerful a year it has been for these small cap companies.
We get a question in the chat, Katie, about are there some companies locally that we should watch within the small cap category? And just to give you, we use the term small cap, but it can be a little bit deceptive because we're not talking, the Lehigh Valley is such a small and mid-sized business community, like closely held businesses. But once you get up into the publicly traded space, these businesses are a lot bigger than we might assume. Yeah. So I'm looking at one particular fund to see what kind of names are in there. And in its top 6 or 7 holdings is Macy's. That's how. So it's a big national brand, but still fits in the small cap category because it's not nearly the size of an Nvidia or Apple or along those lines. I'm not sure where the threshold used to be, like $5 billion in market cap. I think that's since gone up to even to the $10, $20 billion range, even to make it into one of these funds. But we're still talking about really large companies that might not be, if you're looking for like local ownership, it might not be around here necessarily.
But it is interesting. I mean, even though, we're talking about the Russell 2000 and getting access to small cap companies and make sure you have that broad exposure. And, you and I, we do often talk about how important it is to have that broad exposure. But there's different ways to gain that exposure. So I like this next chart where we're looking at kind of more specifically, maybe at an approach level or a product level to. So let me just explain what we're looking at here. We're overlaying the Russell 2000 that we just talked about here in orange. And in purple is, we're using for an example here, the Avantis small cap value fund. And this is looking at performance over the past five years or so. And what we want to talk about is like the ingredients and how it matters, the way that you approach investing in them. So just going to touch on what they call like factor-based investing for a minute here, where we can actually screen out or fund companies can screen out or search for certain factors within a company to decide, all right, I'm going to keep it in the fund or I'm not going to keep it in the fund. So in this particular case, what they're highlighting here is holding on to more highly profitable companies versus lower profitability companies. And that's what this chart is looking at down here. Dennis, if you want to kind of go over sort of this bottom chart here and why that makes a difference and how that shows up over time, I think it would be really helpful just to kind of understand there are different approaches to gaining the sector exposures that the asset class exposures that we want to make sure we have.
Yeah, so this really comes back to the evolution of investing over the last 40 years, where there were ideas that started percolating in the 70s about what factors contribute to performance of stocks in the long term. And there are things like smaller stocks tend to perform larger, more profitable stocks tend to outperform less profitable stocks. And it used to be that you had to hire an expensive fund manager to pick those stocks, and the classic star manager that we mentioned in the beginning. Now with the advent of ETFs and also better technology and screening processes, you can buy an ETF that screens for profitability. And what that does in the short term, in this bottom chart, in the 1 year, high profitability companies beat low profitability companies 66% of the time. Over the 5-year period, it's 82%. Over 10 years, it's 90%. And over 15 years, 96% of the time. So if we know that certain factors contribute to that, and we can accomplish it in a low-cost ETF, over time, you can see, this is going back to the 2020 era, in the short term, they look the same, but that gap starts to yawn as you go further along. So if you're a long-term investor and you can look for these factors, that's one of the ways that we try and add value to how we construct a portfolio, is to try and think of better ways to accomplish the things that we know work in the long term. And this is a great example of choosing a product that's effective and serves our purpose and it's going to hopefully lead to better outcomes in the long run.
Yeah. It's just a little behind the scenes. Let's move over to emerging markets for a couple of minutes here, because I think there are some great highlights here that we can pull forward as well.
Yeah, as Katie pointed out earlier, emerging markets are another area where the stock market returns have been very strong. Here's what we're looking at. A lot of small print on here. This is looking like the World Cup pool of 48 countries right here. But you can see everything. Here's Korea. We mentioned Korea's outperformance in the trailing 1 year. Massive performance there. All the way over to Indonesia on the right-hand side. Anything in this light blue color on the left is an emerging market. The darker green color is a developed market. So that's what we're talking about. Netherlands, Austria, US is right smack dab in the middle. And then the global average is right there in the middle. Look where the global average is and how many countries to the left are emerging markets. And so much performance is coming from there. You're going to have a lot of exposure to Samsung and companies that Taiwan Semiconductor and other companies that are kind of global names. But these are countries like Chile, Mexico, Spain, Egypt, Colombia, Hungary, Taiwan, Peru. They're places where if you're just buying individual stocks that in the US, you're missing out on this portion of what's happening in the rest of the world. We don't know how long this story lasts, but you have to be there when it happens in order to capture some of the returns. And again, there are places to do this where you have funds that can screen for some less savory elements, and understanding what it is that you own is important. But just capturing some of these emerging markets names has been a helpful contributor to performance so far this year.
Yeah. But at the end of the day, it's still important to focus on the broad picture beyond just the investments. Making sure that, as Dennis said, it's not about catching access to that thing, that one fund, that one stock, that one strategy that's going to create success. It's bringing all of this together. It's bringing the financial plan together. It's focusing on the feelings that you get when your ducks are in a row and you have reasonable expectations for how the plan's going to move forward, how your investments are going to move forward, because you've taken the time to think about, okay, what are the long-term goals and how are we working toward them? You build in that discipline. It really is a disciplined approach to make sure that you're not chasing some of those elements along the way, but that things are in the context of the bigger plan. And as we've been talking about this entire time, investing broadly, globally, asset allocation, it really does drive that performance. And you can't just be invested in the last thing that made money, or you're going to miss out potentially on the next thing that's going to make money for you. And always paying attention to the costs and the risk levels. And once again, that discipline to rebalance. It doesn't always feel great to sell when things are high. So you're like, oh, it can make a little bit more. I don't know if I want to trim those equities yet, but that pays off over time, because we know we're going to have periods of volatility, and we want to make sure that we do have reasonable expectations about how your investments are going to react and how that is going to impact the overall plan. So just good reminders on that side.
All right, we can hang around for a couple more minutes. If there are any questions, feel free to drop them in the chat. Katie, I'll just ask you one thing.
Sure.
Is there anything that surprised you or caught you off guard in the second quarter?
In the second quarter, I know this war with Iran has been carrying on. I think the inflation piece of it, the rates piece of it, I have to admit, I was in that party that was so certain we were going to have rate cuts this year. And I feel like we just kind of flipped around, and I'm still reconciling a little bit of, okay, so what does that mean for rates? What does that mean for inflation? Yeah. We've talked about it a little bit, but I feel as if that has continued to be a little surprising for me. How about you?
I think kind of along the lines of the IPO conversation, I think what happened, and this wasn't a second quarter event, but it's a recent event that I think is helpful. What happened to IBM stock last week? In the short term, anything can happen to one stock. And if you miss the news, IBM had to pre-announce its earnings and with a negative outlook, and the stock dropped 25% in a day. And like that's, I mean, if we talk about long-term stable holdings, dividend payers, things like, why would IBM stock drop 25% in a day? Well, things change. And I think it's important to remember that, those basic tenets of diversification and, diversification and prudent management and making sure that we're not putting all of the eggs in one basket is really important, even for a stock like IBM. It's not just SpaceX, it's not just Palantir. It can happen to any one stock. And I think it was a good reminder and a little bit of a wake-up call.
Yeah. I think it's always surprising too when we do see like companies that you just may not even think of or hear of, or certain sectors that do pop up, and all of a sudden they're racing ahead. Like there's just thousands upon thousands upon thousands of companies out there, and you can't pick and figure out which one is going to be that next flyer. I mean, it is important to have that broad net so you capture it. And then when you see something is taking off, you're like, oh, great, I already own it. Okay.
Yes. What I did. Yeah. That's great. Well, thank you all for joining us today. We appreciate it. If there's any questions that you have about your portfolio, or the way we think about the markets, or just want to get into more detail on one of the topics we covered today, happy to hear from you. We appreciate you being part of our community, and we look forward to seeing you in the fall.
Take care. Thank you.